Hi there, it's Kevin Bell. Just wanted to talk about the home buyer's plan or what you need to buy a home in Canada. Basically, you need three things to buy a house. You need income, you need credit, and you need a down payment. So getting into the details of each of these, income, the total amount that you can borrow is based on your income, minus any other monthly obligations you have, including car payments, credit card debts, etc. These rules are set by CMHC for insured mortgages. So with a credit score above 680, you can be approved for a mortgage with up to 44% of your gross income going to service your debts. With a credit score between 600 and 680, you can be approved for a mortgage with 42% of your income going to service your debts. A quick example, both Mike and Allison have a credit score of 660, combined income of $60,000 a year, which is $5,000 a month. Because their credit score is 660, they can have 42% of their income going towards debt servicing. So that works out to $2,100 a month. That's available for mortgage payments, property taxes, and heat if they have no other debts or monthly obligations. If they had a car payment, for example, of $500, the $2,100 would be reduced to $1,600 a month. Credit card balances are calculated as 3% a month. So if they had $10,000 in credit card debt, that would reduce their income that they have available for debt servicing by $300 a month, be left with $1,800. So if they had both the car payment and the credit card debt, that would $500 and $300 reduce the amount they could borrow, or their monthly payments could at a maximum be $1,300 a month. Your credit score is considered when lenders and most importantly mortgage insurers consider lending you money for a house. You can qualify for a good mortgage with a credit score above 600, but you generally have a lot more options with a credit score above 680. The RRSP loan program we'll get into shortly needs a minimum credit score of 640. Ways to improve your credit score: always make your minimum payments, reduce your balances owing as much as possible, use less than all the credit you have available, and you can certainly monitor your credit through Equifax. I'd encourage you to do this at least once a year just to make sure everything is correct. There are alternatives called B mortgages, which involve higher interest rates and larger down payments if you have a credit score below 600. Generally, I recommend people focus on improving their credit score before looking to buy a house. If you had a previous bankruptcy or consumer proposal, it is still possible to get a mortgage. Lenders like to see 2 years of re-established credit before considering a mortgage. So that involves 2 credit lines of at least $2,500 each for 2 years and not missing payments. The third thing you need, in addition to income and a good credit score, is a down payment. You need to have a 5% down payment to buy a house in Canada, and this can be a big obstacle for a lot of people. So one way we help is through a RRSP loan program, and as mentioned previously, need a minimum credit score of 640 to qualify. So some of the questions I have often received about this plan are, do I need an RRSP to start? No. Basically, the way the plan works is we get a RRSP loan approved, we open the RRSP, and we put the money in your RRSP. Key thing to note is that the money needs to be in your RRSP for 90 days before closing, before it can be withdrawn tax-free with the homebuyer's plan. What do you need for approval? Basically a credit score above 640 and the income to support the RRSP loan payments. And these payments would also reduce or be included in your monthly debt service ratios, so the income to manage both payments. RRSP loans, very low interest rates, 3.2% for 2 years, up to 5.2% for 10 years. They're open, which means they can be repaid at any time. And again, as previously mentioned, the approval is basically automatic with a credit score above 640 and repayment terms of less than 2 years. For longer term repayments, if you wanted to repay this loan over 10 years, for example, lenders like to see some assets on your application. potentially money you've already saved towards a down payment, existing RRSPs, tax-free savings account, RESPs, other financial assets. So for me, to get everything approved, it's just a matter of collecting information and making a plan. That plan can include improving your credit score. I can help tell you how to do this specifically. Get your down payment if you need to increase your down payment, and let you know how much you can spend on a house based on the ratios we discussed earlier. So this would be called a pre-approval. And for me, it's just a matter of gathering information to get the approvals and permission to check your credit. What I need is a driver's license, photo ID for all the borrowers, a pay stub that has your year-to-date income, and 2 years notice of assessment. So this notice of assessment is the paper the government sends you after you've done your taxes. The information I need from it, or the lenders need, are your income, social insurance number, and whether you owe any taxes. And for me to get started, I just need this information, and then I can start to make a plan for you to get into a house, stop renting, and begin building equity for yourself. If you have any questions, give me a call, 416-769-1440. Talk to you soon. Bye.